Okay, good afternoon, everybody, and welcome to today's edition of our live market analysis, USA edition. Today, hopefully, we can find something that is not plunging in value in the stock market universe, maybe something we can add to our portfolios. Look, at the very least, potentially something we might have to get rid of. Selling, knowing when to sell is just as good as knowing when to buy. Pretty simple format. If you haven't seen live market analysis before, it's all down to the people joining me in the Zoom session and live streaming on YouTube, LinkedIn, Twitter, Facebook, and anywhere else you can find me. Get the questions rolling in your Q&A window, and I'll give you my best technical and fundamental analysis readers. There's the charts, good. They have appeared. Look, S&P ASX 200 resources index on screen. Give you a hint, I'm going to talk about that one when I appear on Ausbiz in a little while. But what I might do is head over here to our USA master, click on Agilent for no reason, but it's the first cab off the rank. And I do have a bunch of questions coming in here, which is wonderful. But perhaps before we do, maybe we should head back and just have a quick look at the macro. If you caught me on Twitter today, you saw my US indices overview, and we might as well start off with the NASDAQ on screen. We had been hoping, there's that word hope, that this rally through January, this one here, was going to change this trend around. And it wasn't just from the price action, the technicals, the candles looked very good. We got above the long-term downtrend, which had been so pesky in the past at pushing us back down. Short-term trend had turned up. The market breadth factors were overwhelmingly bullish, as in more bullish than they were at the height of the 2021 and 2020 bull markets, okay? But you need to get on with it, and circumstances conspired against the potential for a new bull market. We saw a very, very hot January jobs number. We saw Fed rhetoric pivot more and more to, apart from the word disinflation, to further tightening or tightening, further interest rate rises more than markets had anticipated, quoting Jerome Powell just during the week. And we just haven't been able to get on with January's positive momentum. And you can see just the lower series of peaks and troughs. That's your great indication there. Candles haven't been completely terrible. If anything, you can see within the declines, there are actually a bunch of white candles. There are a few lower shadows even appearing. But as healthy as that is, looking at those peaks and troughs, the market is still giving way. We're still finding more reasons to sell on the downswings than we do to buy back on the upswings. And last night's candle, I do think, is really quite definitive in pushing us back into, at best, a neutral stance, and probably at worst, more of a bearish stance. The probability that we are going to move back into what is proving to be a very belligerent bear market is increasing, and certainly on a close below this little trough low here at 11,273, I think the NASDAQ is in a great deal of trouble to test those lower retracements, 11,069, 10,804, and then 10,207. So what this is telling us in terms of using these big indices as a gauge for how we manage risk, we should have very, very little risk on the table to the long side at this point in time. You're pretty much going flat, and if you're going to, again, yourself be belligerent, you could run into some trouble if you're going to continue to fight the market. Looking, that's growth. Obviously, we'll look at another growth sector in a second, but I want to talk about the Dow Jones Industrial Average, which is typically value. So these are supposedly your blues to blue chip stocks. Plenty of banks in here, and that's part of the problem. So I'm not sure if I can find it. It'll just take me all of about 3 seconds to do so. The banks were the problem last night, and if I head over here to US indices, and you can see the NASDAQ banking index. That's one of the key US banking indices, quite a broad range of banks of all different sizes in that one. And you can see what happened last night, really over the last few nights. So we don't often talk about crypto in these sessions, but unfortunately, one of the banks there, SVB, is the ticker code. Silvergate, as we know, we'll probably find it later, is the name of the company, running into some trouble with some of their crypto dealings. And then there's going to potentially knock-on effects. So who's exposed to them? Who's exposed still to FTX and everyone else? So et al. And what we don't want to see, obviously, anytime, whether you're bull, I don't say bull or bear, bears don't care, is a credit crunch. So we've gone from, well, there's a problem with the economy potentially because the Fed is jacking up interest rates, to, well, some of the problems with the economy, some of the problems with the rampant speculation which occurred as rates were zero for so long, is starting to spill over into the creditworthiness of some of the key market participants. Hey, I don't want to scare the pants off anybody, but I don't like the look of this chart. This is the NASDAQ backing index again over the weekly time frame. And just think, well, if that was a stock, what would Carl normally say about it? What would he say about the candles? What would he say about the price action? What would he say about the trends? And we know when things do sort of come back to that long-term trend zone and they fail to get above, and they can often flip around there. We've seen that so many times, haven't we, in our live market analysis sessions? But when that decisive break is made, and then often after even a retest, it's all over Red Rover. So that's looking really concerning. And then if I'm going to scare you even more, maybe I'll head back here, because looking at the GFC, you can see really that GFC was all about a credit crunch. It doesn't look as horrible as that just yet. Hopefully we never get there, but I'll let you do your own comparisons between that. Look, we're still holding above this, I guess. So just sounding out some of the key issues for us to consider as we go forward today. The other key probably macro data point that you would be worth looking at is the yields, interest rates, obviously price of money, one of the most important factors that impact the stock market. And we saw the US 2-year notes actually come off last night. So we had worse than expected weekly jobless claims. So they popped up, just over 200,000. No big deal, to be honest. But the yield sold off a little bit on that. Well, a little bit, erased the last couple of days of gains, to be fair, but looks like a pretty decent black candle. And normally that would help us out on the stock side of things. But when we look at something like the Russell 2000 and you see a super big black candle like that, just almost a perfect Maribozu to the downside on the fall in the yields, it's not about yields this time. So most of this downturn through here was being caused by those rising interest rates, particularly those short-term rates, to a lesser extent the longer-term rates, because they weren't rising as much, hence the inverted yield curve. So this was that linkage between the US 2s I just showed you was the reason for this, until last night, where clearly those US 2s, the yields were down, but stocks got belted by an equal amount. So this candle here is about something else. And I've explained to you what the something else is. Okay, that's the concerns about the creditworthiness of right now just a few players, but hopefully not anything worse than that. Okay, with all of that wonderful, happy stuff in mind, let us get to your questions. Hanelli's got Starbucks. I'm not sure if anybody's going to hang around after that. Let's go to the USA Master List, okay, SBUX, which was looking great, to be fair. It was A-OK before some of the recent carnage, but yeah, like many charts that were looking good, when things get as bad as they are right now, it's going to be hard to hang on. And I can't see any reason why you would continue to hold a full position here. It's just the price action. We just can't fight it now. And, we've got lower peaks, lower troughs, a little dalliance there maybe, but still taking out that minor blip in here. It's still showing that supply is building. Hey, is it as bad as some of the other charts we're going to see today? No, it's not. But clearly we have moved from our demand side market, where demand is clearly greater than supply and sustainably so, into more of an equilibrium phase at this stage, but starting to lose the grip on even that equilibrium and potentially moving into the supply side market here, where supply is now greater than demand. And what changed in the process? Well, we've seen supply increase, basically, so that it has moved to equalize with demand. The candles aren't great, and the fact we continue to take out those little mini trough lows is also concerning. So there was probably reason earlier than this, to enact some of the exit methodologies that we often discuss here, but certainly last night's candle gives you another minus 1/3, and the best you would be doing here is holding on to 1/3 possibly for a bounce off the long-term trend zone, but you can't really think about holding a full position there on Starbucks, unfortunately, at Nelly. Let us head over here and move away from Wesfarmers on the Australian market. If you're only watching these sessions and you're maybe based in the US, I do other sessions during the week. One of them relating to Aussie shares, where obviously I'm based and many of my listeners are based. But this spreadsheet works equally well for both. We just need to make sure that the end of years line up. I know these generally almost invariably should be December year ends, but don't worry, the numbers are correct. I've double checked those. What we have here is you can't see it yet. There it is. The Thomson Reuters Refinitiv icon spreadsheet, and it's a spreadsheet for the most part supplied by them, and then this stuff here is supplied by me. It's my intellectual property, but through a bunch of formulas in the background allows me to get an idea of whether something is looking, cheap, fair value, or expensive. And for the most part, basically my theories and formulas leverage off what the brokers are doing, the biggest brokers. So I don't go out there necessarily and try and come up with my own EPS estimates for companies, because I feel it's not the best use of my time. And I'm a technical analyst as well, first and foremost. So what I do is, much like my technical analysis is about analyzing what the market's doing, respecting what the market's doing, and then trying to follow that. Really, my fundamental analysis is very similar. Looking at what the market's doing, respecting what the market's doing, understanding that, yes, I could come up with a very different idea, but who cares what I think anyway? It really only matters what the market's doing. So we've got the consensus estimates here of 30 brokers and research houses. Their highest target for Starbucks is 138. Their lowest is 180. Quite a spread there, but their average is 111.93, which allows 11.6 upside. In terms of their ratings, a little bit mixed here. We've got 5 strong buys, 10 buys, and 21 holds, 1 strong sell. So you wouldn't say it's really skewed to the upside there. Most brokers are sitting somewhere in the middle. Then I head down to the EPS line. I want to see bottom left top line growth. I want to see consistency through something like a pandemic. We didn't see that for obvious reasons. Stores are closed. You can't do a lot of online shopping for Starbucks in most cases, let's face it. So look, they did suffer. And I can forgive that, to be fair, because really that's not a management issue there. But otherwise bounce back pretty well, a little bit of a hangover here, and then generally the growth is pretty good, as seems to be the case for most of these US stocks, to be fair, that I'm seeing now as we do these sessions. So the brokers are predicting a 21% compound annual growth rate for my forward-looking period, which is typically 3 years, which is fantastic. Now, what would I pay for that? Would I pay 22.7 times in the PE? I probably would, actually. I don't think that's unreasonable. How does that 22.7 compare to the last 5 years range? Well, it's actually significantly beneath that. So it's not like we're holding it to, well, actually, we've got a very high hurdle rate. It's probably the best way to put that. Looking forward, I think that sounds pretty reasonable. So I don't have any reason to disagree with that, because that's the broker consensus looking forward. And that is more than a reasonable price to pay for a 21% compound annual growth rate. So I can't see anything here that would suggest to me that these numbers aren't right, which says that, we're right now, we're at good value for, good value is 104, which is higher than where it is. Right now, we're seeing very good value for Starbucks, my fair value target 122, which is better than the brokers. So, let that cloud your judgment from the chart as much as you wish, I guess. Microsoft also from Nelly, she says that it is holding on. Let's have a look. And it is just holding on. It doesn't look anywhere near as good as Starbucks did, let's face it. So it's not one necessarily you would have been chasing or holding using my trend following system before obviously the recent market pullback. It's looking probably worse, obviously, since the recent market pullback. Let me just get rid of all that so I can see what's going on here. The long-term trend, short-term trend dynamics. So let's have a look at that. The short-term trend is this one. It goes green, then you can see it turning orange. It tried to get back to green. Let's call it neutral at this stage, and the long-term trend is also neutral. So neutral is a pretty good sign that there's not a lot you need to do just yet. What would need to happen for us to become more bullish on this? Well, we need to see it stay above the long-term trend zone. So we need to see it stay above, that's not what I want. We need to see it stay above this zone here. It's not doing that. So to do that, we would need to see something like this, price action, which shows continuation of higher peaks and higher troughs. Actually not bad, isn't it? It could do that pretty easily if it closed above 260. So that's somewhat encouraging. We'd want to see the candles turn white. So we want to see these sorts of candles in here. These are our demand side candles. And it's important we establish this at the start of every presentation I do. It doesn't take long, copy paste, but these are the ones we need to see to feel that the demand is coming back in. So these are our demand side candles, or our demand buddies, as we refer to them. And if you start to see some of those coming in and around here, particularly in the light green zone, that's where I'd be looking to get involved. Okay, but until then, I can go a hold on this one and not a buy. And look, I don't think you need to sell it either. Where would you need to sell it? Well, I think if it starts to trade beneath here, this one's in big trouble again. Okay, so that low there, I'll give you the low of it. And if you're not sure, look up here, 245.61. Okay, but until then, probably can go a hold. Let us have a quick look here at the Microsoft numbers. Let's see if they've changed. They're always changing. I know we probably looked at these either last week or maybe the week before, but they are always changing. We still have 45 brokers. Amazing, isn't it? Just the thought of that. Your average Aussie stock has maybe 15 brokers at most. We've got a high of 348, low of 212, average 285, allows 13% upside. Very much skewed to the long side here. 19 strong buys, 26 buys, 8 holds. So very much liked by the US broking community. In terms of the EPS line, is it bottom left top right? It is. And that gives me every confidence that it can pull off something like this, which is 16% growth. Potentially not as much growth as StarBucks, but that whether that is good or bad will depend on what hurdle rate we're holding it to, how high a hurdle rate are we holding it to account in terms of the PE. And we're actually got a lower PE than the previous one, but still I think reasonable for a 16% compound annual growth rate. Obviously I need to, actually that's going to change now because I've done that, not much really, but we're still seeing here that we're pretty cheap on Microsoft, and that 21.9 is well below the 5-year range and looks pretty reasonable through here as well. So I can't see any reason why I shouldn't agree with my fair value estimate here of 25.24, and to be fair, look at that, almost exactly what the brokers are thinking as well. So I can't see any red flags to anybody owning Microsoft at this stage, and that's all I'm looking for in my fundamentals, in my valuations, to say, look, is there something really at odds in my fundamental evaluation to make me doubt a really good technical chart? And that's all it is. Let's keep moving now. We've got Nike from Hanelli. Hanelli's on a roll here, NKE. That's obviously not Nike, so we just need to click on that and then try it again. There it is. Starting to lose the grip. Again, another one which was just looking so good, wasn't it, before the recent pullback. And despite, let's face it, the pullback being quite protracted and quite painful, this one has held up pretty well. But much like the first one we looked at, StarBucks, I think it is also losing the battle. So I think it's, again, you can put on the cap of, look, it's blue chip, it was really strong, it'll come back, it'll be fine. And that's your choice. We'll probably find the valuation supportive of that. Or you can say, well, just in the interim, it's more likely to go down than it is to go up. And I can always get back into it. Two scenarios here. I get out, it only goes down a little bit. Everything is right in the world. Forget Carl's analysis on what the banking collapses down the track. But, you know, none of that bad stuff happens. And it goes back up and I have to pay a little bit more to get back in. All right, that's scenario one, in which case you're probably cursing my name and my analysis of saying, well, you probably should exit a bit. Scenario two is the really bad stuff does happen, and as good as Nike is, it goes back to 85, and maybe somewhere down the track you get a signal to buy it back in at 95, in which case you save yourself, you know, $20. Maybe that's a scenario. So I can't tell you what to do. That's not what this is about. I can only give you my analysis to say, well, this is where the price is more likely to go in the medium term and maybe even in the long term. In the short term, it's heading down. In the medium term, I think it is now heading down. In the long term, it's just holding on, isn't it, at this stage to this level here. But beneath that, it starts to get a little bit sketchy. Could I be holding a full position on this based upon my philosophies? No, I can't. I think we've had reason up to this point to warrant taking some risk off the table. I think you can hold some as well, just on the basis that there is some demand here, but beneath this low here, and it's 117.34, so that low there, things are starting to get a little bit scary. So let's say a close beneath that. If you're following the system, then you're probably doing that, and it might even be a little bit more, because to be honest, you had reasons before this even to act. Okay, and it's just about respecting market conditions and saying that, I'm really, as a trend follower, you're a fair weather sailor, and you're saying, look, I'll wait till the market starts to look good again and I'll get back in. And if we're going to start the next bull market, things are going to go up 30, 40, 50%, conservatively speaking. And if I miss out on 4 or 5% to be sure of that, that's okay, because I don't want to be holding for the next 30% down, which is a real possibility looking back at these sorts of scenarios in history. Let us, I was going to do the Nike. Let's head over here to the, you can see why. I mean, I've got two kids. One's 11. My son is 11, and it is really all about what you have on your feet at this stage now. And this is still the premier brand. I know there are so many possibilities out there, but this is the one that 11-year-old boys respect the most. And my daughter as well. She's going to be 14 soon, and it's all about your Air Maxes and all that other stuff. And she's got a couple of pairs. I know he's got a couple of pairs. And to be fair, they made me buy a pair very recently. I've got a pair of Nike Dunks, which apparently is good. It makes me seem young and cool, it seems. Let's look at what the brokers think Nike is young and cool. 185 is their highest target from the 32 brokers covering 85. Huge range, isn't it, some of these US stocks. And we've got a 129.44 average, which gives us 9.8 upside. We're looking at compound annual growth rate of about 20% over the look forward period. And we've got earnings that do not go bottom left, top right, but there was a very good reason for that with COVID causing some issues, and then some pretty solid growth from there. So that's all good. The highest PE we've seen, but not for the highest growth rate we've seen. That's interesting in itself. So that tells you that brokers do apply a bit of a premium to Nike, maybe just because it is such a premium brand. We can see, however, that 27.3 is definitely the lowest of the potential candidates there in the 5-year PE range. So it is a good hurdle rate for us to use. It's probably closer to the bottom end of the ranges compared to some of the other ones we've seen. It feels a bit high for me, to be honest. Not unreasonable for this. It feels high for me, and I don't know exactly what I would put on it. Maybe a 25, but I don't want to just pick numbers out of the sky. But yeah, I would say that 135.13 is probably a bit high, which means I'm happy, therefore, to defer to the broker's assessment of 129.44. Okay, I don't think that's unreasonable given what I can see on screen. But there are no red flags there. No red flags saying that Nike is ridiculously overvalued at this point in time. Let's keep going. Barry's got Meta. Let's head over to Facebook, or the previous Facebook. And what did we say last time? I said that we needed to see, look at this, it almost exactly occurred. Look at that. So I drew this the last time we looked at it. I can't say, maybe it was a couple of weeks ago. And I said, you needed to see this white candle, right? You see that white candle and that price action to add 1/3 risk. So you would have done that. And I can't see any reason at this stage to not stick with it. But it also highlights, I guess, the benefits of using a model where you don't go all in at once, okay? Where we're rewarding stocks that continue to perform with more risk. And I keep talking about adding risk. I don't say I'm going to buy some shares, do I? I don't think I've ever said that to you. Oh, look, at this stage, we're going to buy some shares or stocks. We're not going to do that. I've always spoken to you in terms of we're going to add risk or we're going to reduce risk, because that as a person who has taken the responsibility to manage your portfolio, that's what you are. You're not managing stocks, you're managing risk. Okay. So we either add risk or we reduce risk, and we reward stocks that do well by adding risk to them, and we punish stocks that aren't doing well by taking that risk away from them and turning that risk into certainty, because stocks are risk. And I've always said that basically you have to think of stocks as a big ball of risk. That's all they represent. Yet I think it's probably fair that most investors would say, oh no, Microsoft, that's safe. I say Microsoft is risk. Google, no, that's a blue chip. Alphabet, that's safe. No. It's a stock. Therefore, it is risk. And that risk must be managed. Because I think people that fall into this comfort zone of, I've got a bunch of safe stocks in my portfolio, they're the ones that hold on all the way down when the what does hit the fan. But I think the investors who truly believe and just defer to this belief that, I'm holding a huge portfolio of risk here. When things turn bad, they're more likely to say, I need to deal with that risk right now, rather than hold all the way down. I think the idea of adding that risk, I think, is perfectly sensible. I don't think you need to reduce risk yet, but we're not far off it, because 3 out of those last 4 candles aren't fantastic, let's face it. And in fact, last night's candle, I know it was a bad market, totally engulfed the candle before it. If you're super jittery, you might push that 1/3 out and take a very, very small loss. If you've got absolute confidence in Facebook, you might give it a little bit more time. Now, I think that's where I'm sitting at this point in time, because the trend is still up, isn't it? Let's face it, the short-term trend is still up, the long-term trend is still up, but these are slow to react, these trends. They're moving averages, and even though I've made them exponential moving averages, they're still slow to react. The best indicator we have is price action. And if we get another down candle tomorrow, right, let's sort of simulate that, much like I simulated the last one there. So let's say we get this. I know this is very small, a very small batch of price action. In fact, it's not even, because that low is not below that. But anyway, let's say, look, if we get something like that, I don't think you can continue to believe that the best path is to continue to hold that risk. And if you're getting out on 1/3 of what you intended to put in anyway. And that's the benefit of only adding. Where do we add some more risk? Well, we need to get above that high there. It's 190.36, and above that high, I could easily add some more risk to this one, but not until then. Look, it's pretty sketchy. I'm going to struggle today. Forgive me for that, but it's not we're not exactly facing the simplest and easiest of circumstances to make big calls, are we, in markets at the moment? Let's check out this one here. And I will get to streamers in a second. So we've got 47 estimates here for Meta. Again, massively polarizing stock. You can see that in the range from the high to low target, and then just the huge range here. But the average target 209.06, 15% upside, 16 strong buys, 24 buys, so 40 of those 47. And some of them, obviously, I don't know how Thomson Reuters does it. Hey, don't blame me if they don't add up, right? Call Thomson Reuters and make sure you complain. Obviously, these don't add up to this. So there's some others there somehow. 13 holds, 5 sells. EPS line is at bottom left, top right. Well, it was until December 2022, so last financial year. Significant drop back, but then, brokers are expecting a big ramp up. And I am skeptical, to be honest, on the way some of these US brokers think. They just seem to be so optimistic, don't they, compared to our Aussie brokers. Our Aussie brokers are will just punish you if you don't have a good growth outlook. Bang, they're negative on everything. But US brokers seem to be, constantly optimistic. I don't know if it's something about the Aussie mentality and the US mentality. Let's make sure these two line up. Actually, it will change that. Sorry about that. 19%, which looks fantastic. And if you're only paying 14.3 times for 19%, it's crazy cheap. I mean, this looks crazy cheap to me on that basis. So the PE range, we're not so much at the bottom. I mean, we've been lower there. 14 probably looks about right. Could be a little bit high maybe, but only just. But I don't have any reason to argue too much with that. And if I was to adjust this down a little bit, it would probably only bring this more closely to aligned with the 20906. So I can't fault the brokers on that based upon my numbers. So no red flags there either for Meta. Let's head back and do the next one here, which is Tesla. Of course, hey, we can't have a session of USA live market analysis without doing Tesla. And I think it's pretty safe to say, based upon our last analysis, with all of those red arrows, we weren't thinking that Tesla was going to go up. Okay. And it hasn't. But I don't think I can call myself a genius for that because everything else went down. But it does illustrate that you don't want to mess with these dark pink zones, especially when you spend time in it. You can't break above it like so many others did. Nike did, Starbucks did. And you fail, and then you fail at the short, and it's all, 4 black candles in a row, upper shadows. There are no redeeming features here. I'm not sure who asked for this one here, Barry, whether Barry's got it and he's hoping for me to say, hey, Barry, it doesn't look so bad, or he's waiting to buy it. I hope he's not in it. But I can't see anything really holding this up. It was quite fluid on the way up, so it didn't create a number of sticking points in terms of demand and supply to give us that area where it could bounce off. So really, I have to say, well, X marks the spot down here. That low there, 101.81. I can't see any reason why we can't get back down there. So my view on Tesla has not changed. And given that we're not even thinking about holding it, I think many of the other ones we talked about today were buys recently, or, were at least hold. Given that hold isn't even on the table here, I don't see why we would check the fundamentals. And that's my methodology. I'm looking at charts to say, well, this is a great stock. Does it also have a really attractive valuation? Does the valuation support the chart? If I can't find a great chart, then why would I bother wasting my time looking at the valuation? So let us keep moving then, and we will do NVIDIA, which one of my best picks so far this year, NVDA. There we go. Do we keep the faith? I mean, it's been invincible, hasn't it, Therese? Last night's candle is not a good candle. Let's face it. Do you sell a trend this good that's just starting to flick over here on one candle? And I have to say no. In my heart of hearts, I have to say no. No, I still think it's a hold. I don't think there's anything so sinister in there that would suggest that we need to lighten the load. I won't even type it on the screen because I don't want us to confuse ourselves next time we come back and look at it, because I'm not calling a minus 1/3 here. And the future might show us that we should have sold 1/3 here because everything went to poo-poo after this session. It's a possibility, but I can't see the future. All I can see is that as bad as things have been in the US stock market for the last month now, right? We're in March. That January rally it was in January. We had a whole February that really sucked. Look how good NVIDIA's been. So my methodology says you have to stick with it. And that's where I'm going to leave that one. So I think still looks good. Given that it's at least a hold, let's head over here and check it out. I know we probably checked it out last week or the week before, but given that, we've always got new people coming in, they may not have seen those old sessions. Let's do the due diligence. And we can see that we have, I need to keep changing these. It's very frustrating. 39 estimates, 320 versus 110 high low, 248 somewhere in the middle, allows only 6% upside, interestingly. But there's still very much skewed to the upside here on the buy, hold, sell. So 12 strong buys, 20 buys, 12 holds, just the one sell. EPS line is definitely bottom left, top right. We've had a pullback here through January 2023, which will probably be December 2022, to be honest. But then we're picking up nicely through here for some excellent growth, the best growth we've seen so far, and not surprisingly, therefore, one of the highest PEs we've seen so far, if not the highest. But it looks high, but how does it compare to what investors have paid for it in the past? It's still way, way below that low there of 52.81, and looks pretty reasonable going forward. And certainly, I was going to say, certainly reasonable for a 30% compound annual growth rate. It is started to just feel on the high side for me, to be honest. 35 for that is probably a bit high. Maybe 30 is a better number. Maybe 25 is a better number. I'll just show you what that looks like. And you might say, hey, Carl, how do you know? How do you know what's good for a 30% growth rate? And I just kind of know. I just know from having looked at this spreadsheet now for about 15 years, what works and what doesn't. So, if we went 30, we're starting to edge a little bit closer to that 248.44 with the broker zone. If I go 25, and I think that would start to make it actually probably pretty cheap. We're around there. But I can't see anything here to, again, there's no major red flags on the valuation for me on this one. I think it's, at least fair value at this stage. Let us head back to this one and keep moving on your requests. Thank you so much for your attendance and your requests. And hopefully I'm paying you back with some good analysis. If you're not, let me know, because our goal is always to improve here. So I just need to find the right one there, MU. A little bit like Tesla, unfortunately, isn't it? So we can see here just it didn't quite get going through that long-term downtrend zone, unlike a few of the other ones. And you can see that long-term downtrend zone is not something you want to mess with. It's pretty good at terminating promising rallies. Okay, and now that we're beneath it and the trends are turning back down again, and the price action. So if you think about my methodology, you always start with one trends. The reason why I start with the colored ribbons is for when I'm scanning. Okay, so this is a little bit of sort of how-to, right? So if we go, let's go a scan list, and I'm just going to grab a scan list here. And I know these aren't US stocks, but I just want to prove the point here of why the ribbons are there. Because if I'm scanning a big list, and I think we're going to have time. I think we're going to have time to do this. I know. Okay, so just bear with me here, and it'll make sense in a second. So if we do this, I'll do this, and I go save. So I'm now setting up my US long scan, and I'll go to last night's candle, and I'm going to make sure I've got my right list in here. So I've got to go watch list USA master. And if you're wondering why you didn't see that come up, but I've set my US master here, and if I go explore, you can see it's working through. So if you're wondering why I'm not using necessarily the ThinkMarkets platform, I'm just more familiar with this. There's no ulterior motives going on there, right? So ThinkMarkets has a really good platform, which is not on screen right now, but will appear in a second. And it has all the charts for you that we've talked about, and it has your analysis tools and so on and so forth. Okay, but it just doesn't have the ability for me to enter my formulas, and I'm not as familiar necessarily with some of the drawing tools. I need to do these sessions quickly for obvious reasons, to get through as many stocks as possible, right? So there's Microsoft, lo and behold. But obviously this allows me, and I just can't show you the windows because of the way OBS is set up, to show you the formulas that are creating the scans. But I'm just going to stop that there because it's just going to go on and on. But you can see the stocks that have met the criteria here so far. And what I would do is go replace watch list with the results, and then select scan results. And now those Aussie stocks are gone, and we've got US stocks in here. For obvious reasons, that one's on the list. And I'm not sure what, well, there you go. How about that? So from here, basically, I need this. You can see straight away, as much doom and gloom as we've had, what these scans allow me to do is sift through all of that and just look at the stuff that's still looking good. Now, that doesn't mean I'm going to go long everything, because I'm concerned about the broader market. I've talked about being very neutral right now, but at least I can see the stuff. I don't know what's going on there. That's looking good. And I'm going to have some filters to get rid of some of these other ones. But I'm going through this quick. Literally, oh my God, how good does that look? ALDX. So I can get through this quick, right? I'm just looking for a particular pattern. Like I'd stop there. That looks really interesting. ASO. I think that looks really interesting, but probably too late. And this is how fast I go through. And the reason why I can go through this fast, and maybe you're struggling to keep up, is because number one, I've been doing this for over 20 years just on this platform, but and I know what I'm doing, but the ribbons are helping me. I can see the ribbons very quickly. I can see the candle, the color of the candles. Look at those candles very quickly. I'm looking for that. That's why I'm black and white, my candles. I'm not any other candles. I've got the most contrast there. So I can see very quickly what I need to see, and then I can go back after I've shortlisted. It's the way I shortlist, and let's go back to, what's in that one? What was the really good one? ALDX, that one there. So what I do is I right click here, and you can't see it in the little menu that's coming up in this area. You can't see it, but I right click and I go watch list, add selected symbols, down, boom, into shortlist, and it will appear now in the shortlist, all right? And I'm just building up my shortlist of the scan, and then I'll shortlist my shortlist. And I might even shortlist my shortlist, and that's what these extra folders are for. So the first pass, because we saw that the scan results can be really big in America. I mean, I could get back in January, I was getting 1,000 stocks, and that's why I got so confident. I saw 1,000 great uptrends. Obviously, we're not going to get that this time, but we might get 150. I need to be able to get through that list this quick. Okay, so what we were doing before we started talking about this, and this is where I'm going to draw it back to something that makes sense, is in here. Okay, so we're not talking about buy, hold, or sell. We're talking about how you trade and how you set up your analysis. Where is MU gone? Do this, frustrations, and we'll find it here. Okay, so I was saying, look, first thing I do is look at the trend ribbons, and the reason why I've got these beautiful colors, this light green and dark pinks, is that visually, as I'm flicking through those lists, bang, I can see in an instant what they're doing and whether I need to spend more time on that. Okay, so that's number one. Look, number two officially is price action, although that's harder to see when you're going through that quickly. But number three is my candles, and they're actually really easy to see as I'm flicking through really quickly. So you can see I'm starting at the top, the big trends, then I'm drilling down into the price action, and the final flourish is the candles. And if I put all those two together, I'm going to get really good trades. Okay, MU, I can do this one really quickly. I've got no interest in that. Lower peaks, lower troughs. The candles don't look great. High shadows pushing into and being repelled by our dynamic resistance zones. They're our moving averages, and I can't see any reason why we can't come back down to 50 here, and therefore there's no reason to look at the fundamentals on that either. Let's have a look at AMD now. Looks better. You can see it has interacted well with the long-term trend zone. In fact, the last time we looked at it, we said it needs to do this price action for us to get interested, and it has done it. And I wouldn't have any problem, apart from last night's candle, to adding some risk to this. Okay, if you asked me yesterday, I would have said plus 1/3. If you asked me today, so let me just put this on this side, plus 1/3. On this side, I'm just going to say, look, I'm just going to go flat. That candle is not requiring me to add any risk at this stage. It's not a great candle. It's not as bad as many of the horrible ones we've seen, but it does show that we did push into what we expect to be a point of supply, and that supply manifested itself in the market in that candle, and therefore it requires a bit of caution. Buy, hold, and sell. Buy, hold, or sell in this one. Happy to hold the risk that we would have added, not a buy for the reasons I've spoken about, and sell is off the table. Sell is not on the table on this one. Now, because I took so long on some of the other ones, let me just see how many I've got left. Have I got time to do AMD in here? Look, I think I do. So let's head over here and go AMD. And we've got 36 brokers, huge range. Wow. Let's make sure that's matching up. And 11 strong buys, 18 buys, 13 holds. No sells, no strong sells. That's encouraging. EPS line is bottom left, top right. That's great. Through the pandemic, they kept growing their earnings, and it continues through here for what is a very, very solid 22% compound annual growth rate over the next 3 years. Let's change that. Let's go dynamic F. 17.3 is very well below the 5-year range. Nothing sinister going on there to say that that's not the right number to use. It is the median, I think, is a valid measure of central tendency is what I'm saying. I shouldn't be using anything else. And therefore, my numbers come out fairly valued here. I do think that 17.3 is on the cheap side, so I probably could pay a little bit more for that for 22%. And it would only draw me closer to the broker target there of 93.78. So I can say with confidence then that AMD is not overvalued at this stage, and if anything, it's probably looking a little bit cheap. Let's head back here and get through the rest of these. Hanelli saying, thanks, Carl. Fantastic guidance. Much appreciated. You're welcome, Hanelli. Haraju looking at Rolls Royce. Well, this will be interesting one. So let's go Rolls RY, not what I've looked at recently, RYCEF. I'm not sure if I'm going to find that one. RYC. I know that we've got four-letter tickers in the US. I've never seen a 5-letter ticker. RYC. I'm not sure if I'm finding it. Maybe just double check the ticker code there for me. So it's not what I'm familiar with. Harashu, just check that one for me. Michael's asking for JPMorgan, which I'm guessing got belted last night. It is coming up. JPM. There we go. Yes, it did. Geez, it was looking fine before that. And it does demonstrate the surprise element in what happened last night. So the markets weren't on the same page with what happened. And that's concerning in itself. That is a bad candle. So for me, yeah, look, just on the basis of that candle alone, do not pass go, do not collect $200. It's minus 1/3. And now you're just scrutinizing this for the next signal to get out. Like it's a trigger finger now. You're really just any excuse to continue to take risk off the table on this after that, because I know the long-term trend is up, but we closed beneath it. The short-term trend has just switched. We've taken out all of those areas of demand so easily. Why did we take out? There should have been demand there, and there was nothing. There was demand there in the past. It just evaporated. It wasn't there. They got out of town. Why did they do that? What does that mean to you? That's why I'm so concerned. People look at that and go, oh, it's down a bit. No, I go, there should have been demand there. It wasn't there. Where did they go? That's a concern. Plenty of supply in the system. Didn't find them. A demand vacuum. Concerning stuff. Let's have a look at the other one. GoldmanSachs, probably going to be the same chart. In fact, it's better. I'm surprised it's that good, but very concerning here. If I had this one, I'm very concerned. In fact, I'd minus 1/3 just on last night's candle and the way that lower peaks and lower troughs are playing out, and the fact we're actually breaking beneath the long-term uptrend. So at least minus 1/3, but probably more, to be honest, because that could probably come back down into 290. No need to do the fundamentals on those. That's the end of the Zoomers. I don't have anything in the chat, so let's head over to the streamers. And how are we going for time? I've got a few minutes left. GTI, let's have a go here. GTI, is it GTII? Is it actually GTII? What's it called? GTII. If I say it another time, it's not going to appear in front of me. GTI. I'd love to do it. I just can't find it. If you can tell me where it is in that list, and I might be doing something wrong. Let me go up here. There's GTII. I've gone to B, sorry. It's my fault. GTI. Is it that one? Gratify? Just confirm that for me, Jay. Is that the one I should be looking at for you? I don't think so. Just waiting for Jay to confirm that one. Because I can't. Global Tech Industries, or GTII. Now it's going to be hard because I can't search by. Oh, I could go full name. Just try that. And if I should do it the old-fashioned way, I'm doing my best for you, Jay. Global. That's not it. He says good. Okay. Global Tech Industries. Plenty of globals. No, that's not it. I'm doing my best, Jay, but I'm not finding it. I'm sorry. Let me do something else that you can't see here. Just Google it. Global Tech Industries Limited NYSE. GTII. Yeah, he's right. Look, I've got a backup plan. Here we go. Yeah. So I have no idea why Norgate Data doesn't have it, and they may have it. I'm just not looking in the right place, unfortunately. Isn't that frustrating? You can see what I can see there, Jay. So I'm doing my best for you, but I can do it another way. Okay, I will not rest until I get this done for you. So I'm going to head over here, and I'm in trade view now. So that's GTII, and it is right there. Look at that. Oh, it's over the counter. Okay, so I don't have over-the-counter stocks in that list there, Jay. And that's we've figured it out. But geez, it should have been in the all because I do have OTC in here as well. No, maybe I don't. Maybe my data provider doesn't have OTC, as you can see there. Actually, if I go back here, okay. Just to explain, I don't have, Jay, just for future reference, I don't have any securities in my OTC list. Okay, so we've solved the mystery. I'm not going crazy, but I can find them here on TradeView. Okay, I've still got my trend zones there. Very flat, unfortunately, Jay. Not terrible by any stretch of the imagination, though. I really like the way the price action is setting up, and I especially like these two candles here. So I'm talking about this candle here. And this candle here in particular. What I also like is the fact that we've had a very, very shallow pullback through this phase here. So through this phase, very shallow pullback. We're actually holding the short-term uptrend zone. I know it's very flat, but you look at where those candle lows are coming in. They're all at the same level. There is some demand in the system, and on a relative strength basis, last night everything was wiped out. This one didn't. So I think it's okay. I think, look, if you've got it, I'd be happy to hold it. I don't know if I'm a buyer. I just think with all the uncertainty around, but I tell you what, if it closes above that high there, and I'll tell you what that high is. That high is 184. So close of 185 and better, then I'd be happily looking to add some risk on this one. Okay, so let's say plus 1.85 equals plus 1/3 risk on that one. Okay. So buy, hold, sell, happy holder. Is it a buy? No, not yet. I've told you what I need to see. A nice white candle close above 185. Is it a sell? No, I don't think so. And I think that does bring us to the end. NASDAQ ticker RYCEF. I'm getting hit by the technology here, unfortunately. RY. No, let me find it on here. Let's go rolls. Escape. Roll. Escape. Let's go. There we go. Rolls Royce. RR. Let's see, I'm not even finding it. Shit. Pardon my French there. I did all that work for Jay and I was on the wrong screen. You can see Rolls Royce. It's not there, mate. It's here. It's on the OTC market. Okay, so just for people following, I can't do OTC over-the-counter shares, okay, unless I go here. So maybe just let me know. Okay, so sorry, Jay, but what I was saying is obviously I like this candle down here. I like this candle here. I like the fact it hasn't pulled back very much into this candle's range. So all the demand we're seeing here, amazing demand, has not been challenged. That's great. Normally when things go up, people want to sell. You know what? There's a little bit of selling, but not a lot. I like the fact that we're holding this short-term trend zone, and the next push up, I'm a happy buyer. So close above 185, happy to add 1/3 risk on that one. As I said, just reiterating, buy, not until I see what I want to see. Hold, yes. Sell, no. And just for completeness there, let's find Royce, which if we do go to the over-the-counter markets here, RYCEY. I guess that's why we've got longer ticker codes. No reason to sell that at this stage, Haraju. I'm glad we finally got there. These candles aren't great. Yes, we're close to 2, but I don't think that's a major issue. Happy holder, but just be on the lookout. What you don't want to see from here is if we start to sort of, print lower peaks and lower troughs. So something that maybe looks like that, then you would start to manage your exits from there. But until then, I don't think you need to do a whole lot. Okay, I have gotten through the list. Big sigh of relief. Let's head back here and remind you that I do other sessions. I think Jay must be tuning in somewhere in the States, which is just magic. I'm so glad that we can reach out to people and cover these stocks for you. But we do obviously do Aussie Stocks Tuesdays at 1 p.m. And then on Thursdays, we do the indices, commodities, foreign exchange, and crypto. Same format. Obviously, you ask me anything and I'll do my very best. I won't rest until I get you your analysis charts and valuations where possible. You can register for these at www.thinkmarkets.com/au/webinar. If you're not a client of ThinkMarkets, you really should be, because obviously They provide my services to you, but in addition to that, we have the best broking rates for your ASX equities, $8 flat rate. It is Hidden Chest sponsored, but also commission-free on our overseas shares and, in fact, local shares as well, ASX shares. But you can trade commission-free on your foreign exchange, indices, commodities, crypto. We do have the best platforms, and we keep winning awards for both those platforms and our amazing customer service. It has been a pleasure chatting with you today. If you have enjoyed it, hit the subscribe button to stay notified of all updates that come out during the week, and make sure you hit the thumbs up button as well. All the best for your trading until we catch up again. Bye-bye for now. But before you leave, don't forget that everything we've talked about today is general in nature. That means it has not taken into account your personal financial circumstances or particular needs. So before making any investing decisions based upon this info, you should consider it carefully or seek the help of a financial professional. You can find out everything you need to know about ThinkMarkets and our products by downloading our product disclosure statement, our PDS, from our website.